Lynn, as you know, several weeks ago, Treasury Secretary Janet Yellen has issued a plea to Congress to raise the debt limit. Her quote is as following: Defaulting on the national debt should be regarded as unthinkable, she said before a Senate hearing. And she said that failing to increase the debt limit would have absolutely catastrophic economic consequences. It would precipitate a financial crisis. It would threaten the jobs and savings of Americans, and at a time when we're still recovering from the COVID pandemic. Well, she's right. It is unthinkable because it's never happened before. The US has never defaulted on its debt ever in its history. That's why treasuries are rated AAA. It would be unthinkable. So could the unthinkable be possible this time?
Well, it's technically possible each time. It's just one of those things that, pretty much by definition, it's a very, very low probability event. And if it were to occur, it would probably occur briefly and then be rectified. However, for example, some of the things that happened in say the capital of the U.S. Earlier this year were previously thought unthinkable, and they still happen. So, investors have to watch out for these kind of tail risks that can happen. But in general, since the debt ceiling was implemented in the early 20th century, it's been raised something like 100 times, both parties, and it's just it's historically been mostly a non-politicized event. But in certain periods of time, it starts to be used as a tool. And so the way the debt ceiling works is, you're not raising the debt ceiling for new debt. You're raising it to basically pay existing obligations that they've already signed into law, right? So it's not about new spending. It's about maintaining ongoing spending that they've already allocated. So it's different than, say, a fiscal stimulus bill or something like that. And so in some ways, it's philosophically counterintuitive to fight over the debt ceiling because, they already obligated that spending. But on the other hand, they use it as a practical tool to try to get something, from the administration when, because it's basically a strong bargaining chip. It's kind of like playing chicken.
At $30 trillion of gross national debt, we have the highest debt on record so far. This has been asked to Powell before, the issue of the interest rate rising to the historic level of 5.7%. At 5%, not even 5.7, but at 5%, we're looking at $1.5 trillion of annual interest expenses on $30 trillion of debt, assuming, of course, by that point, debt is still at $30 trillion. So could we afford that $1.5 trillion? And we have $3.5 trillion of tax revenues every year. So about half our tax revenues would go to interest expenses.
Yeah, for the early part of the question. So again, the debt ceiling is about funding that's already been allocated. And so the kind of the real question has to be directed to, can we afford further stimulus? Can we afford these kind of structural budget deficits that we have? And so those are kind of two separate debates, because one is about kind of fixing forward spending patterns, and the other one is about paying for previously allocated funding patterns. But going to the bulk of the question, the short answer is no. Basically, at $30 trillion in debt, 5% interest rates, as you pointed out, that would be $1.5 trillion in interest payments, which is a very large percentage of both GDP and specifically of government revenues and government spending. Now, there's a couple nuances there, because that refers to the average of debt outstanding. And so that would include, from the federal government, that would include short-term like T-bills, as well as that longer-term debt. And so that would depend on basically some of those long-term low interest rates have already been locked in. But there is a very, very large percentage of the treasuries that actually consists of short-term T-bills. Last I checked, well over 10 trillion was that very short-term number. And so that basically is tied to the Federal Reserve's interest rate policy. And so the short answer is my base case for a couple of years now is that, this looks a lot like the 1940s in the sense that that's the last time that U.S. debt to GDP was as high as it is now. And basically what they had to do back then was lock interest rates at a very, very low level, even when you had these bursts of inflation. And that's because, they found themselves basically fiscally in a problematic space. And so the downside there is that if you're holding cash or holding bonds, you can fail to recoup your purchasing power during that period. And so that's actually one of the big differences between the 70s and the 40s, is that the 1970s, private and federal debt as a percentage of GDP were both pretty low. And so when you had inflation, you could raise interest rates to combat it. Whereas in the 40s, when you had very, very high public debts, despite inflation, pretty much whatever you do, they couldn't raise interest rates. And so that's generally a pretty good case for holding real assets at this current time, because I think we're still on a path towards currency devaluation. And it could happen in bursts, or it can happen just over the course of a decade of having interest rates that are below the inflation rate.
Okay, so let's first talk about the tools they have to control this problem. You mentioned locking in interest rates as one of them. What does that mean exactly? How can the government lock in interest rates?
Well, for example, if the government issues a 30-year bond at, say, 2.5%,
Yeah.
then even if interest rates go back up, that bond, they still have a fixed contract of coupons to pay at that initial rate.
Okay.
So basically, the extent they lock in that longer term yield, they basically buffer themselves against rates going up. In recent period of time, they've actually been kind of decreasing their average maturity. They've been issuing a lot of T-bills, and so a very big chunk of that debt is susceptible to an increase
Right.
in interest rates if the Fed were to do that.
Okay, so most of their debt is relying on variable interest rates, is what you're saying.
A good chunk of it, yes. I mean, they have that full spectrum from very, very short all the way up to 30 years, and a very big percentage of it is under 5 years.
Now, what about the possibility of interest expenses reaching? Is there a number in your mind, Lyn, where interest expenses become unsustainable, unaffordable? What's that number for you?
Well, once you would see kind of average treasuries getting up to maybe 3% or so, that'd become pretty fiscally kind of impossible. And I would actually already say at that point, at where we are now with both the United States and as well as some other developed countries, debt as a percentage of GDP pretty much almost mathematically can't be kind of serviced in real terms. Meaning that we're in an environment where most paths kind of point towards currency devaluation, and so that could take the form of, say, interest rates being 3% while inflation is 6%, or it could take the form of interest rates being 1% while inflation is 3 or 4%. And so there's a couple different kind of ways that could look like, but they all involve pretty much having these persistent periods of negative real yields, which is, again,
Okay.
that's a problem for pensioners, challenging environment for banks, just challenging for any saver or bondholder.
All right, so currency devaluation is one consequence of the path forward. What about for the stock markets? Obviously, the high debt to GDP ratio is not anything new. It hasn't happened overnight. Yet, equity markets have continued to rally ever since 2009, if you ignore the blip we had last year. What do you think?
So in the 1970s, inflation was very, very bad for stocks because interest rates very quickly to combat that. And so when you have higher interest rates, you have to adjust your equity risk premium accordingly and pay lower valuations for stocks. Now, the 1940s were different because despite inflation, they did not raise interest rates. And so stocks actually did pretty well in that decade from their initial lows around 1942. The difference now, though, is that stocks are going into this period of very, very high valuations, whereas back then they were very cheap. And so, the short of it is that it partially depends on what levers they're going to do. So if you just kind of run a massive deficit, keep interest rates below the inflation rate, do big currency devaluation, then equities can ironically do pretty okay, at least in nominal terms. They can kind of, maybe have a mixed outcome in real terms, do okay in nominal terms. Now, if on the other hand, that the government starts to kind of try to rein in this deficit issue, and they start to say raise tax rates on corporations, or they pull other levers, that could start putting serious downward pressure on equities if they decide to go that route. And so that's, investors are watching big tech for, regulation or tax changes there, as well as the idea of kind of a global corporate minimum tax. That sort of thing should be on investors' radar.